Okay, let's answer some questions from the last market outlook. And if you hear some banging in the background, it's because I'm having my roof repaired. The heavy rains are coming here in Costa Rica, and there are sort of wear and tear in terms of the joints on the roof. It's a metal roof on the structure. So rust appears, that kind of thing. So you have to have your roof maintained every couple of years. You have to have it sealed and repainted. So that's what's going on. So if you hear something in the background, that's all it is. I'm doing this early. This is Tuesday morning while I'm doing this, only because there were quite a few questions about India and about Mexico that just seem to have taken quite the dump on the election results. So I will answer that as best I can when I get to it. But let me just preface that by saying, if you think back to November of 2016, when it was announced that Trump beat Clinton, that night on the results, markets took a tank, didn't like it at all, and then it went away. So we'll deal with each one as we get to it. Glad to tune in on Dr. Mark's weekly rant about earnings. I wish I didn't have to rant about it. It just seems to me odd that you can't get something like that right. Came for the weekly earnings calendar rant, left with a promise for level 4. Can't complain. I got the applied series back in the day, and I can tell you a lot of material. It's well worth it. Oh, I thought we had questions here. Here we go. Return to office doesn't seem like it's driven by free market dynamics, so it has to be enforced by government or corporate edict. Well, before you had the pandemic, there were lots of people who didn't like the commute. So it wasn't so much that was free market dynamics. Corporations are not democracies. They are dictatorships. You have a CEO at the top, and they say what's what. There's not a vote. So you don't enter the lobby of the building and go into a cubicle and vote for what marketing you're going to do that day, vote for what the corporate strategy. It doesn't work that way. It's a dictatorship, a benevolent dictatorship, but still a dictatorship. If we allow people to make choices in a free market for everything, kids would eat chocolate bars for breakfast, lunch, and dinner, but we don't let kids eat chocolate bars. We basically dictate what they're going to eat. Well, employees are the same. If you let them choose what they want to do, it would be, you wouldn't get much work done. I know you like to think that, everybody really wants to work. That's not true. That's not true. The 80-20 rule applies here, that 80% of the output of your organization is done by 20% of the people. And the other 80% are doing, are really seat fillers. They're really not going very far. Oftentimes, you have to oversee them. So I don't know that I would say that it's not driven by free market dynamics. It never was. It's unfortunate because there's literature being published that shows senior talent are leaving firms with stringent return to office policies. Even late last year, occupancy was only around 50% of pre-pandemic levels. I just can't see a return to any pre-pandemic levels in terms of return to office, with hybrid work arrangements and remote work becoming the norm. Well, I don't know if it's becoming the norm. Another assumption in there. Downturns will have to adjust to this new normal. I don't know that it's a new normal, and that will likely be painful for CRE. I think there was a work from home. There's always been home office and work from home cohort. I can remember in the 90s, some people who were part of organizations had their own home office. And there's a timeline, and it has been, trending up over time as technology allows it. It has been trending up over time. Then you had a pandemic, and then you had a jump. I think the trajectory that we were on probably is going to have a different slope, but you have this big jump up here. I think it has to come back down to a certain level, and then maybe you have a different trajectory that maybe in 10 years, you could be at a level that makes sense, but not until monitoring technology gets a lot better, and not until jobs can be designed such that that output can be measured. Some jobs' output is very difficult to measure, such as a lot of cognitive jobs, jobs where there's research going on, where you can work for 7-8 months in a row before you get a significant breakthrough. Well, how would you measure that off-site? How would you measure somebody working on a complex algorithm off-site and not making any progress for 2 months, 3 months, 4 months? And difficult to do. Not only that, I can tell you straight up that face-to-face interaction for working through a problem in which you don't know the answer yet, where you present a problem and you say, here's the problem, here's where we'd like to get, what's the pathway? The give and take that you get, I get more out of that than a scheduled 1-hour Zoom meeting after everybody thinks on their own. So I think it's just a matter of time. This is not the new normal. Okay, it's not the new normal. It's still the abnormal. This trend over here, this was the normal. You know, I think it was like 5% of all jobs were performed at home. I don't know that you can have an economy that's going to be competitive with a Chinese economy with 50% of people working from home, because work from home is you start Monday at around 1 p.m. and usually Thursday at around 3 p.m. you're off. If you work from home, you'll notice that no meetings are ever scheduled for a Friday, and no one returns emails on a Friday. It's a 3.5-day weekend every week. It's a 4 or 5 hour workday. The number of Zoom calls I've been on, from different people from different organizations, where they're sitting in their backyard, or they're just sitting in a cafe somewhere on the side of a street, and you can see the cars going by, and this is not serious business, people. I have different opinions, I guess. Love the intro reviewing key economic data. I keep it coming. Oh, okay. Not a CFA candidate, but came across your video some time ago, and I find them very helpful and instructive. Retiree, can you offer a subscription from September for people who just want to learn more about economics in your weekly updates? The weekly updates are still going to continue to be on YouTube. At some point, they will be half on YouTube, half on my site, but not anytime soon. And the reason for half on my site, they're not going to be behind a paywall. It's just 1 week it may appear on YouTube, and 1 week it'll be on my site. There'll be a free side, but it'll be there. Why? Because I want you on my site. I want to slowly bring all of you onto my site, but that won't be for a while. So you don't need a subscription for that. Maybe you're not interested in doing this, but I believe there are a lot of people who, like me, who would find your education and deductions valuable. So yeah, everything that you see on YouTube will stay there for quite some time. I haven't made any decision about moving that yet, but in time, I will taper you to the free side on my site in time, not now. Brief update on the election results in Mexico would be appreciated. Saw EWW drop 11%, peso weakening against the dollar. Yeah, let's see where it is today. I've got my system open here. Let's look at Forex. 17.79. It was worse this morning. It was over 18. I'm not quite sure if this is an opportunity yet. I don't know if the new leader is just a continuation of the previous leader because it's the same party, or if there are more radical departures to the left that this one wants to institute. So I don't really know what to say on this one, other than we had the same reaction with Trump, and that sort of went away. These election results tend to be just that, events. And anything that's going to be changed, or anything that's on the horizon, usually is slow moving enough that you can see it coming. So I don't know that just the election on itself is enough to say, oh well, that's over, right? Same with India. I don't know that it's enough to say, oh, that's over. Typically, you would see a problem coming a long time away. And I don't know that, I think the big problem with Mexico, the big concern is the environment, the more environmental lean that the new leader is going to have. It is in, if you're reshoring some work from or factories from China into Mexico, because they do have inexpensive labor, even with the increasing of the minimum wage. You want it as close to the American border as possible in the northern area. Well, it's the northern area that is challenged in terms of water availability. So it may be that no, you can't build anything in the northern regions because there just isn't enough water, or we have to conserve the water. That would create a bit of a problem. But until something like that, you'll see it coming. So I seem to think that if you give it a little bit of time, let's just play it out for the week. Maybe let's see what the central bank says next week. I think Mexico's already begun the rate cutting cycle, first in North America to begin the rate cutting cycle. Let's see what the Fed says next week. Let's see where the peso plays out. It might be worth taking tiny positions right now just to say that you're in the game. I think it's overdone. I think it's the reaction on the event is overdone. So I think I've said enough on that. I'm not going to answer every question the same way. I think we have enough on that. Maybe the Bloomberg article said that AT&T and the other telcos are sitting on massive piles of copper cable, which they slowly dig out of the ground as they replace with Ethernet. And this can bring them extra revenues given how high copper prices are. Let's be careful there. Copper prices are for refined copper, not for recycled copper. So you have, let's say you have this long line of coax cable that has a copper core, and you're replacing it with fiber. So you have a cost of getting that out of the ground. Then you have a cost of stripping it and getting the copper. Then you have the cost of getting it to the smelter. Then the smelter buys it because the smelter's got to recycle it. And then the price out of the smelter is the price of copper that you see, not the price going in. There's a huge amount of cost getting that there. That it's not enough to justify the market value that was added to AT&T over 2 days to say, oh, they got a lot of copper. Copper in place, you can say copper in place has this price, but try to put it into another use. You have to get it. You have to, first of all, salvage it. It's not free. It's not as if you could just call a truck and load it in the back of the truck. You got to get the cables out of where they are. You have to get the copper out of the cable itself. You got to strip it down. Then you got to transport it to a smelter. The smelter will get the money on the way out. You'll get some money on the way in, but there's a cost to that. So I would say it's one of those things where the asset value is way above its liquidation value. CFA question. Working in IT, completed CFA level 1, 2, 18, 19, restarted level 3 journey, and bought archive levels to get a refresher. Having some challenge without the PDF. I understand at the time of purchase it's clearly mentioned that PDFs are not available. Oh, for the archives, yeah. But is that something you can reconsider? I don't own the business anymore. It really isn't my choice. But yeah, there are no PDFs for the archives. It would be a lot of work, I think, to maintain multiple years of PDFs. And the cost of getting that done, there's no way you could get a level 1 archive for $65. There's no way we could do it if we had to manage multiple years and multiple versions of PDFs. Lots of videos that can watch at 2x speed, but having the document in front will help other listeners. Please vote if you have the same problem. What you can do is at the top of the video, and this is not a bad idea here to help you with the PDF. At the top of the video there is a light bulb which will turn the background white and will turn all the colors in a way that it works on the background. So any black screen you're watching, you could turn it white by clicking the light bulb. It take a screenshot of the screen that you're looking at and then import it into anything like Sketchbook or Microsoft Paint or something like that. And then you should be able to do, once it's on the screen, you should be able to make your own notes, point, do this kind of thing, and then you can save it as a TIFF, and when you open it up in preview, it'll give you the opportunity to save it as a PDF. Now, obviously, you're not going to need every single screen. You'll watch some videos and go, I already know this. I really don't know. I really don't need to know that. But that is one way that you can create your own for the ones that you do need. Let's see. In one of your past videos, you mentioned that the E in 12-month leading PE for S&P 500 is operating earnings and not net earnings. Yeah, because you have, let's just do a simple one. You have revenues minus cost of goods sold, and that'll give you gross profit. Gross profit is in dollars, margin is in percent. Then you'll subtract out your operating expense, and then you'll get to operating income, and then you have a bunch of one-line items. Well, those are one-line items. They're difficult to forecast, and when analysts forecast, they always forecast zero for these. So their estimate is operating income, not earnings per share. Whenever I see printed PE for Nvidia, E stands for well, it depends. Are you looking at TTM, the trailing 12 months? If you're looking at trailing 12 months, that is reported EPS. If you're looking at next 12 months, it is usually operating earnings on that one, because we don't know what the EPS is going to be because of one-time items. All companies have deferred tax assets, deferred tax liabilities, so it's hard to predict what the net income is going to be, so it's usually predicted out to operating earnings. Update about models, which we're going to make from scratch in the applied level. I'm going to be using Damodaran's Damodaran's model. It's good. I see no reason to reinvent what is already good, so we're going to use that one, and we're going to see how we would build it if we had to build it, so we have an understanding of it. Concerning end-of-day positioning, could you please explain the rationale or mechanics of such trades for both investors, traders, and market makers? For the latter, my sole understanding is that market makers do rebalancing to keep delta neutrality. Yeah, they do that every day. I don't know that would explain the big move at the end of Friday. I think that was money being committed to the market. It was the end of the month, and for reporting purposes at the end of the month, you don't want a lot of price risk, so you try to put your positions on as close to the close of the market as possible, so that at the end of the month you don't have reporting that shows that you have these unrealized losses. You try to be as close to the market as you can. How do you reconcile a bearish view on EV and bullish on semi that is heavily dependent on the EV market? Well, just because you sell a gold miner a shovel doesn't mean the gold miner is going to find any gold, right? Just because you sell tires to an auto manufacturer doesn't mean the auto manufacturer is going to make money selling the car. Just because a company or there's a lot of EVs being produced doesn't mean they're going to sell, and if they do sell, it doesn't mean they're going to be profitable, but they still need the chips, right? So it's one of the things where you're going to build a car. Copper has to go into an electric car, and you need more chips going into the car if you're going to be putting a lot of automated systems in there. Even if there's overproduction in vehicles, even if they're breaking even if some companies are losing money, they had no choice but to still build the car, right? So you can be bearish on the car and bullish on the inputs. You could say, look, there's going to be a lot more EVs built because of the regulatory push. They're all going to require these inputs, but it's questionable whether anybody's going to make money by selling the vehicle in the end. So you can be bullish on one part of the supply chain and bearish on another part. What are your thoughts on consumer spending using their credit cards? I think I answered this in the live stream. I don't believe these GDP growth are natural. I think consumption continued, but it was financed with debt. My debt is somebody else's savings. I can't spend a dollar unless somebody somewhere saved a dollar. I cannot just come up with money. I can only spend somebody else's savings. So I don't know that that I would doubt the numbers. Do you think 1.5 trillion in credit card debt will become an issue, or do you think it is a solvable problem? I think you have to look at credit card debt as a percentage of consumer income. So incomes climb over time. Well, if there's a certain percentage of income that is credit card spending, you'd expect that to climb over time. So it's hard to look at absolute numbers sometimes. So when we look at company debt, we may see company debt has done this over time. That maybe it started with 50 million, now it has $500 million worth of debt. But if this 50 million represented 40% of assets, and this 500 million represents 40% of assets, debt has just grown in line with assets, which means it's no more burdensome than it used to be, even though it's a larger number. So you have to look at things like debt levels in context of something. Credit card debt as a percentage of GDP, credit card debt as a percentage of consumer incomes or household income, but as a percentage of something. As incomes rise, you would naturally expect the amount of balances carried to rise as well. So I don't know that looking at the raw number is something that you can say, oh my God, we're going the wrong way. And I don't know the relationship of credit card debt to any other number at this point, so I would leave that to you. Why is ADP always wrong? I don't know that we would say that it's wrong, but it's always different. So we don't know whether the labor survey is correct or whether ADP is correct. ADP uses actual payrolls, and then from that attempts to forecast how many jobs were added. But there are people who enter the workforce and leave the workforce all the time. There's a lot of churn. So their payrolls pick up the churn, and from that they try to say, okay, well, this is the natural churn that we would expect to see, whatever their algorithm is. And so based on the numbers we've seen, it appears the economy added net jobs of 200,000. And then you have the labor survey. They're both surveys, so they're both incorrect to some degree, but they're always different. So maybe not calling it the always wrong, but the always different ADP. Wondering how you're assessing EWW. Already talked about that. Hedge fund strategies covered in level 2 achievable for retail. Some are. Equity market neutral, long extension, long short, dedicated short are all achievable by retail investors. I don't know about a lot of the ARB strategies, capital structure ARB, convertible ARB. I don't really know if I would say they're achievable. It would depend on the availability of the security, but some of them aren't. Some of them are, especially when you start getting into strategies that involve CDSs and some OTC derivative contracts. You're just not going to be a counterparty to that. You're not going to be significant enough or come with enough scale. Change your Oxy strike price given the somewhat mixed announcement. No, I just sold more at the 60. I sold more at the 60 today. Let me have a look at where they are. Oxy, the 60s are, my screen's printing 186 is the midpoint. I sold some 210s today, $2.10 at the 60. We're at 186, so it looks like we got a little bounce. But still selling the 60s. If it continues on, yeah, I will move to the 57, 50s and the 55s, and I'll get more aggressive and bigger at each strike price down. My understanding of the BSM, correct. Similar to binomial option pricing, option valuation model, the price of an option should be its expected, it should be the present value of its expected payoff, calculated the sum of the probability weighted future payoffs. Calculated as the present value of the sum of the, okay. Okay, you're missing present value, but I see what you're going. Indirectly estimates the probabilities of each future asset price by looking at the normal probability issues of log returns. Yeah, the return, the log is normal. Okay. The log normal distribution of asset prices can be converted to logs, which are themselves normally. Yep. When using z-scores to estimate those probabilities, BSM attempts to account for the randomness of asset prices by including the drift component, LR plus 0 squared over 2 over 21 T. I think maybe you mean sigma squared. I don't know. LR R. Oh, it's a bracket. Oh, this should be a bracket R plus. Oh, I see. Okay, you got it over here over 2. Okay, so that's not a 1. That's a closed bracket. Okay. I was thinking, what's this 0 squared over 21T? Yeah. Yeah, a little bit more. I think a little bit more than that. But, you know, if you're trying to figure out if you got a grasp on it at a high level, yeah. During your live session, you mentioned that T is on your watch list for the time. Could you share which other companies are on your watch list? Are those you are actively engaged with by selling puts employee? What else have I got? Let's head over to some stocks here. Looking at, I keep USO up just because I think there's a floor price on oil. GM I watch. Ford is on there, but I'm not really excited about Ford. TLT is always on there. TSN, Tyson Foods is on there. I have your usual suspects: Meta, Apple, Amazon, Google, just in case there's a one-day event where something really goes crazy and something goes on sale. Mining companies, BHP, Rio, FCX is in there. You know, it's a number of different companies from a number of different sectors. I'm seeing FCX here down a lot, down 6.23%. That is the Indonesia tax, the 7.5% tax, which I don't think is going to be a big problem for FCX because it is building a smelter in Indonesia. So yeah, it's not a nice thing that they're going to have to start paying the 7.5% export duty on copper concentrate, but their smelter is not far off. So I think it's overdone a bit. Let's look at where copper is. I expected copper to pull back. It's down almost 12 cents. So it's a double hit for FCX because it has the copper exposure and it has Indonesia exposure. So it's a double hit for them today. I'll probably give it a day or two, and then for FCX, I got the 47 puts. I might be interested in the 45 puts depending on you know how it plays out for the day, but I'm on a sort of a, you know, when there's negative sentiment and there's blood, just stand back for a bit. You know, there's no point in rushing in, but I probably am going to add to my FCX position because copper long term, there is no way around it. If you're going to send electrons around the world, you need copper. The more electrons you send, the more copper you need, period. So I'm good with a long-term hold on that. Copper will, at some point in the future, break $6 a pound, then $7, then $8. It will have to. Live Q&A, you mentioned 100 unrealized loss in an option is already taken from my cash. Yes, they are what are called MTM. Any derivative is marked to market daily. So if you're showing that you're down $100, the cash is already gone. If I sold a put, well, you can't sell the put unless you mean that you sold a call. If I sold the put to acquire the stock and received the premium, oh, I see what you're saying. You're setting up an initial. You sold the put to acquire the stock, you received the premium, but its unrealized P&L is negative. Why is it that this $100 loss considered a cash loss when it reflects the difference between the strike price and the stock price I'm going to hold? Well, all it means is that if let's say you sold a, let's just give a really simple example. Let's say you sold a $40 put for $2 and the stock is at 37. You will have a $100 loss on your option. If you then say, well, then put the stock to me, great, you'll own stock at $37, but your cost will be $38, giving you a $100 loss on your stock. Either way, you have a $100 loss, no matter how you do it. So the option is just holding the unrealized loss until you have the stock put to you, and then that $100 realized loss will jump over to the stock position. Is there a case where I do a cash secured put because I want to hold a stock long term, but it's more convenient to sell the option because its unrealized P&L is positive? You did a cash secured put, you want to hold a stock long term, but you're making money on the put, and you're thinking, should I just take the profit on the put? You can do that. Let's do the same thing. Let's say you sold a $40 put for $2 and the stock is sitting at 39. So you're up $100 and you're saying, is there any value in taking this $100? Yeah, you can do that, but are you abandoning the idea of holding the stock long term? Is the quick gain overriding your desire to hold the stock long term? What was your original motivation for selling the put? If it was to hold the stock long term, and you're taking the $100, you're sort of abandoning the idea you had to begin with. So you're basically saying, I'm changing my mind about my strategy. If you're not changing your mind about your strategy and you say, well, this is kind of nice, I don't want to give that up, go out to the next month, go to the $41 put, sell the $41 put, and this is sitting at 39, and as it climbs up, you can continue to roll over, and you'll probably do better by rolling up the puts over time. You'd make as much, I guess, or maybe even a little bit more than the underlying would provide. The danger is it goes much past the 41 and you think, I should have taken it when I could have got it at the 40. Now it's run on me and I can't get it. When short a bond, why does an investor have to pay coupon to the opposite side? Wouldn't the bond pay the coupon on the long side? Well, yeah, but now you have two long sides. Here's me, here's you, here's the other person. I don't know you. I don't owe you anything. You're not family. I have a bond. You want to borrow my bond, so you're short the bond and you're going to sell the bond to this person. Well, who am I? Who are you that I should give up my income for you just so that you can make money? Who are you? I don't owe you anything. I'm long the bond. I lent you the bond, but I'm still long the bond. This person's long the bond. You're short the bond. So the coupon goes to this person. And I say, hey, buddy boy, I lent you the bond, but I'm not giving up my income and sitting on the sidelines while you make money. Come on. So you got to pay me my coupon. Right? So coupon, minus coupon. The minus cancels this out, one coupon. But I am no longer the owner of the bond if you borrowed it from me and sold it. So that's why you owe me money. As a non-US investor, or as a foreign investor, generally speaking, what should I consider with regards to taxes when investing in foreign markets? Nothing. All your gains will be taxed in your own market. The only thing you have to think about is the withholding tax. So if I'm holding a European stock and it pays a dividend into Canada, there is a 30% withholding. So if it pays $1, I'll only get, or a euro, I'll only get 0.7 euros in Canada because there's that withholding tax. And then Canada will tax me based on what I receive. So the only thing you have to consider is the withholding tax. Small investor, what trades would you make today or tomorrow to maximize today or tomorrow, but not the next day, just today or tomorrow to maximize the small investor advantage? He mentioned in some videos that this advantage could be significant, but I'm struggling to grasp how to implement it. Well, the small investor advantage means that I can move in and out of positions rather easily without raising any alarms, without raising any eyebrows, without even being seen. If you are in Well, let's look at the options chain here, and let's just look at where is my complete options chain, and we'll look at I don't know, ABR for example. Very light volume. So let's say that you were going to sell the $15 calls for July. It's 20 to 25 cents, which is not a bad spread for a retail investor. Deadly spread for an institutional investor, 5 cents. And let's say you want to trade 2,000 options because at a large size, that's the only thing that makes sense for you. Well, the volume today is only 75 contracts. If you tried to trade 2,000, you're 20% of the open interest. You will never, ever get it. You can never take advantage of a mispricing on Arbor in the options because you're way too big. You'll never get the volume filled, and you're going to need volume to move the needle. Otherwise, it's the return you get is not worth the time you put in given the size of the fund that you have. Whereas I can, right? I mean, I can. It's not a big deal for me. Because I'm small enough that if I were going to do 30 options, there were 75 today, I would have been filled. So that is the advantage. I'm sorry you had a silver chart pop up on the screen. Let's get rid of that. Did not look good, did it? So if I had to do a trade today or tomorrow, I don't know. It wouldn't matter to me. I mean, there's nothing that I can't do with 50 or 100 options. It just wouldn't matter. But if I had to, do 10,000 options just to move the needle, well, then, I'm really looking at large cap stocks that have volumes and options. There's a whole bunch of small cap stocks that I would just be out of the market on. If you sell puts on a futures contract, how to make sure you don't have to take delivery of the copper in case you are assigned the futures contract. No broker will allow you to hold a contract into the delivery period. You will have a forced close. If you don't close it, they will close it for you. But they are not set up for delivery, and they wouldn't let you hold into the delivery period. Would you always have to close your short position before assignment? Pretty well, before the beginning of the assignment period, yes. You said that you mostly enjoy the quantitatively driven subjects like fixed income derivatives and CFA curriculum. I'm curious to know why you mostly like sector studies module rather than options and portfolio module and applied level. The latter two modules may more quantitatively driven. So there's a big difference between a textbook and the real world. The narrative topics you find in textbooks are really boring. They're not that real world. Numbers to me are super easy. They're just really easy. Numbers are easy. But 130 pages on ethics. Come on, man. I'm bored out of my mind. Or an academic writing the narrative part of portfolio management is like, well, this is really textbooky. I don't know how real world it is. The real world is a little bit messier than that. The sector studies are real world. It's not some economic theory about how things normatively would work in a general equilibrium within a general equilibrium model. It's real world. That's why I tend to enjoy those things. Even though you are not contributing to MM package development for CFA level 1 and 2, you still recommend MM level 1 and 2 packages. Well, what do you think that I'm going to say? So it's one of those things where, no matter what I say, somebody will always say, well, you have to say that. So it's hard. Even if you give an honest answer, it's hard to do that without somebody saying, well, what are you going to say? I mean, what would I say? There's no way I'm going to say no, not at all. My voice is still in level 1 and level 2 by a lot. So my answer to that question is yeah. Yeah, I still recommend it. But again, if somebody wants to say, oh, you're biased, I have no defense against that. Well, of course I'm biased, right? What do we got? It seems the wealth transfer phenomena we are witnessing is amplifying, as is the erosion of the middle class. What evidence do you have of that? You're making a statement, but I'm not going to accept your statement. You're going to have to provide some evidence that wealth transfer is amplifying and the middle class is eroding with the strength of unions over the last while, and with the evidence of wage gains from the Atlanta Fed wage tracker showing that the larger wage gains have gone to the bottom income groups. You're going to have to provide evidence of that statement. I'm not just going to accept it. If salaries don't go up, who says salaries aren't going up? And the wealthy own most of who says the wealthy own most of everything? And I think you're confusing income with wealth. Those are two different things. What would be the outcome? Do you foresee any economic adjustments, or are we in Latin America in terms of disparity? No, not Latin America in terms of disparity, simply because if you are in Canada, you have social mobility. You have paid education all the way to grade 12. You have the ability to go to college for a very heavily subsidized price, college being trade schools, or to university for either loans, scholarships, and if you are Canadian, going to Canadian university, again, a very subsidized price. There is social mobility in North America, in both the US and Canada. Not so much here. Not so much here. You have a very small group of people who are very wealthy, who put forward politicians, who pretty much own the politicians. The level of corruption here is off the charts. You are born poor, you are structurally poor. It is difficult for you to get out of that. It is difficult for you to get out of that. What Latin American countries need is a redistribution of educational opportunity. Not wealth, just educational opportunity. Because if you can educate the population, they will create their own wealth redistribution mechanism. That's the best wealth redistribution mechanism there is the free market. I don't agree with many of the statements that you're making. You're making sentences, I think, based on maybe ideas you would like to be true, or maybe stuff you heard somewhere without any evidence. Income does not equal wealth. These are two different things. Wealth is not about what you make, it's about what you keep. So even if incomes go up, if you continue to spend everything you make, you get no wealth. 75% of workers spend every penny they make. They live paycheck to paycheck, not because they don't get money, but because they don't save money. So they have no wealth because of the choices they make. Now, if you want them to have wealth, you're going to have to restrict their free choice. They are not free to spend the money as they see fit. They are not free to spend their time as they see fit. You will dictate to them what they will buy, what they will save, what they will eat, and how they will spend their time, and you will fix wealth inequality. The threat, or the biggest driver, I shouldn't say threat, the biggest driver of income inequality is skill and education inequality. And within each skill and education category, the biggest driver of inequality is the risk of the profession. So let me give you an example. You have a neurosurgeon, all right, and you have a Walmart checkout clerk. Would you be surprised to learn that the neurosurgeon makes more money than the Walmart checkout clerk? Would that surprise you? Would you pick up your placards and begin protesting in the street that this is unfair? Probably not. You'd probably say, well, I mean, duh. Of course there's going to be jobs. Some jobs pay more than other jobs. Great. So what you have to do with all of these jobs out there, before you decide to say, oh, these people make this much and these people make barely anything, is you first have to adjust them for the skill and education level. Much of I said, look, here's portfolio A, portfolio B, portfolio C. This returned 44%, this returned 12%, this returned 6%. Obviously, everyone should be in portfolio A. You would say, whoa, 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 my good friend. You must consider risk. You must adjust these returns for risk, because we might find out that this over here has the highest Sharpe ratio. And if it does, you can lever this up to get this return at much lower risk. Right? You would first say you must adjust for risk. Well, if you have incomes, you must adjust for skill and education levels. Now, within an education level, let's say, and I'm going to take a little bit more room here, if you think there's inequality, let's take what the Bureau of Labor Statistics does. Less than high school, less than BA, and let's say you just adjusted for that and you say, okay, let's just look at this population. Because when you look at income inequality across the population, you're making the statistical mistake of including multiple populations in your sample. That's a rookie mistake. That's a Chapter 3 Introduction to Statistics mistake, is including multiple populations in your sample. So within here, what are you going to find? You're going to find this kind of distribution in terms of income, as you're going to say. The top 10% seem to have the highest level of income within that group. It's recursive. But in here, you still have one more step to do. You have to adjust for risk. So you have a factory worker, and let's say you had somebody with less than high school who throughout their career built, through sheer grit, built their own factory and is the owner of the factory. Who has more risk? Obviously, the owner has more risk here, so we would naturally expect the owner to make a higher income because they're taking on more risk. It's their whole livelihood, whereas the factory worker gets a paycheck every week. So even within the category, you must adjust for risk. I put it to you that in an economy like Canada or an economy like the US, if you took all of the incomes and you adjusted for skill and education, and then within each group you adjusted for risk, you will find that much of what you see as income inequality disappears. Or what you would say is unfair inequality disappears. The inequality you see is fair. It's fair based on the level of skill and education you have, and it's fair based on the level of risk that you have. There's very little inequality. Very little inequality. Now for wealth, it's about what you keep. So you can have two people making the same amount of money. One is broke all the time, the other one has wealth. You get 100,000. I get 100,000. You spend everything you make, I save 50,000. In the next year, you get 100,000, I get 100,000, plus I get income on the 50. What have I got? I've got income inequality because I make more than you. I have wealth inequality because I saved more than you. All from my free choice, and all from your free choice. So if we're going to solve wealth inequality, we have to eliminate free choice. Is that what you're advocating for? Because if you're advocating for everybody making the same amount of money and nobody having free choice, you are 2 steps away from Stalin. Is that who you want to be? Is that where you want to be? You are making some very rookie moves in your statistics if this is what you're doing, if you're not controlling for these things. So I reject almost every part of your statement unless you can demonstrate evidence in a rigorous way, the way I presented it here, which I don't think you can. All right. Previous market outlook, you mentioned that higher interest rates don't seem to be having much of an effect. Well, I don't know that I mentioned that so much as mentioned that I can observe that. It's more of an observation. Did an analysis on CSX not long ago and noticed that CSX and its competitors issued a lot of debt shortly before the Fed started raising interest rates to combat inflation. Wouldn't be surprised if companies in other sectors did the same in anticipation of rate hikes. Yeah, a lot of companies saw it coming. I'm surprised banks weren't a little bit more aggressive in seeing it coming, but a lot of companies saw it coming, issued a lot of debt to lock in debt, and probably overlaid those with swaps. Even if they issued floating rate debt, probably overlaid it with a bunch of interest rate swaps to lock in low rates. If this is true, how much of an impact do you think rate hikes have on the overall economy? Well, they haven't had any effect. Housing prices, all-time highs. Stock markets around the world were hitting all-time highs. Multiples getting stretched to over 21 times forward earnings on the S&P. It seems that assets only went in one direction, which is straight up. Unemployment near all-time lows. So when you look at that, you got to say, hey, Fed, I don't think it's working. Kind of like the Princess Bride, But you keep using that word. I do not think it means what you think it means. So it's more like, you keep raising rates. I do not think it does what you think it does. Where are we here? I have a question. Currently study economics, statistics, and data science, and the economics part is so unrealistic and unpractical with contrast to what really is. So there's a big misunderstanding about what economics is supposed to be doing. Economics is a simplification of reality. Reality is complex. You can't solve a complex problem. You can solve a complicated problem, but you can't solve a complex problem by its very nature of its networked effects. You cannot solve it. You have to tame the complexity somehow, so we have models which are simplifications of reality. A model sometimes does nothing more than reduce the variables of concern. So we may have a model which has assumptions 1, assumptions 2, assumptions 3, and they may be unrealistic assumptions such as no tax, no transaction costs, and perfect information, right? You've seen models like this. And then you have some model and you think, but that's not the real world. So what you have is you have a description, right? Here is the full description of the real world. And here is what the economic model does. This is more normative. There is complexity. We have to reduce the complexity. This gap in here is where you'll find behavioral economics, right? Trying to explain this in here. You have to reduce the complexity. So what we're saying is if we see this going on over here, based on our model, it must be because of taxes, it must be because of transaction costs, or it must be because we don't have perfect information. You've reduced the complexity of the problem. You haven't solved the problem, you've just reduced the dimensionality of the problem. And that's what economics is good at, is their simplifications of the world. Pay attention to the assumptions that got to that simplification, because the real world is a result of a breakdown in one of those assumptions. So if you think we're not getting what we need to get, is it because our taxes are suboptimal? Do we need to do something with tax law? Is it because transaction costs are too high? So if we think, let's say in the real estate market, that things are just not working the way they want, economics is one thing, but in reality we have another thing. Well, when you have 6% transaction costs, there's the problem. Maybe you need a new model in here. Or maybe there is something in the economy that's stopping the flow of information from one source to another source. But there you go. You now have some dimensions on which you can work on to solve a problem that economics says we are suboptimal for some reason. It must be because of your assumptions. Everything in economics, always look at the assumptions. Don't just breeze over those and think, oh no, it's the model. This generally, that's the big thing. No. Everything lives in the assumptions, because the assumptions tame complexity, which means if we accept the outcome, any difference between the textbook outcome and the real world must be in here. That's the beauty of it. I'm thinking of switching to accounting instead of economics. What are your thoughts about that? Well, you're going to have to wear your pants a little higher around your stomach, up above your belly button at least, because that's what accountants do. They wear their pants really high. Right? You're not cool anymore. If you're sitting at the cool table, you're going to have to move. So yeah, you can do accounting. You can do accounting. I love economics, but not what they teach in university. Well, I would say you can continue to love economics. What they teach in university is just you got bad teachers who are not making the point. You're not making the point, and I would say that most economics professors have a hard time demonstrating how their model could be useful in the real world. We don't ask the value of a model by saying, is it a good description of the real world? It's not. We say, is it useful in understanding the real world? And if the answer is no, then you throw it out. If it is, aha, that's it. Tell me why it's useful in understanding the real world. Don't try to convince me it's a replication of the real world. It simply isn't. Currently an undergrad student in Canada, thinking of writing level 1 in August 2025, long way away. Want to get the applied level before the price increase. My question is, since the latest exam, I cannot currently register level 1 through CFAI and have to wait until early bird registration in November. So if you're going to take level 1, August 2025, that option's already available on our site. You can already select level 1 for August of 2025. You can already do that. And then you could just register for it with CFAI when it becomes available. My new life goal is to become Mark's neighbor. Well, in Canada, I still have a house there. I have 2 neighbors already on either side of me. And here, I own the properties all around me. So you cannot become my neighbor. But I get what you're saying. What are your thoughts on private credit? It's been growing very fast and everyone seems optimistic about it. However, not everyone acknowledges the risks of higher rates, interconnectedness to PE industry, limited transparency to valuations. Yeah, it is a it's big. More money has gone into it. And yeah, information is not as available as you would in other, as it would be in other places. People say loans, and people say, who are people that are say, people say, who are these people that are saying these things? Loans are safe as they are secured, and they have tight term. Well, listen, all mortgages in 2007, 2008 were secured, right? Now, that doesn't mean no defaults just because they're secured, and that doesn't mean that the security will be enough. If you have these correlated defaults, you could drive down security valuations. That does not mean the security is going to pay for the principal. So. High supply of capital can soften the very terms as it already has to some extent with spreads tightening for recent deals. Do you think this could turn out to be a systemic risk? Everything can turn out to be a systemic risk. Everything. That's the idea of complexity is, sure, everything has the possibility of morphing into something else. What will do it? You don't know. That's the problem with systems like economies. They're complex. Everything could be okay, or one little tiny thing could result in huge effects 2-3 months from now. You just don't know. That's why it's so difficult to engineer an economy, because you're trying to engineer an adaptive complex system where you cannot. It's not a matter of it's hard to forecast. You cannot forecast what will happen, and sometimes your forecast will cause you to take actions that then create the very thing in an opposite direction you were trying to avoid, because it's a complex system. Think about it this way. You have a big balloon, and you bigger than your 2 hands, and you're trying to squeeze the size of that balloon. No matter how you squeeze it in one side, you'll expand it somewhere else. Right? That's the economy. You squeeze in one part, you'll create distortions in another part. So does it have the potential to hurt? Yeah. Is it going to? Who the hell knows? Who the hell knows? Could you explain why stocks of companies in the financial sector tend to trade at a discount to their net asset value? Well, for the most part, if you have a balance sheet that is financial assets, you could, in theory, replicate those financial assets, unless there is something to the name, that there is some brand that a financial company has that gives it some extra value. If you have interest rates that are expected to drop, the market will anticipate increases in book value, and these companies can trade above book value. But if you have interest rates that are expected to rise, the market will anticipate the rise in rates and a drop in book value per share, and that company will trade below its book value per share. So it's not that it trades below the book value per share, it just may happen to do that now. Or its net asset value per share, it may just happen to do that now. Could you explain how and why behind closing a short position in options? Why would you close it? It's either made its money or it's losing money. How? If you're short, you just buy. All you do is buy the very same option. And the clearinghouse will see that you're both short and long the very same option and will give you a zero position. If you're so sure a stock is going up, wouldn't it be inconvenient to do a cash secured put since the probability of reaching the strike price is lower and you may not get the stock? That's why you would then increase your delta. If you're absolutely certain that the stock is going up and there are options and you have and there's time value in it. Let's say there's a $32 stock and you want it assigned to you and there's a $40 option that you can get for $8.15. Do it. And even if it's put to you the next day, your average cost is $31.85. The market's trading it at 32. You just bought it for $31.85. If you're gonna buy it anyways, why not get it 15 cents cheaper? And if it doesn't get put to you and the stock begins to rise, well, all the way to $40, you're going to make the same money plus the extra 15 cents. I don't know why I said $8.15 as in time, $8.15. So as long as there's some time value, you just sell in the money puts. Go to a high delta. Go to a delta of 0.8 or a delta of 0.9. You'll always squeeze out some pennies. You'll always squeeze out some pennies at that. Last week, TLT pretty much rebounded, but anyway, it fell at the beginning of the week. TLT is not a stock. If you're trying to figure out what's going on with TLT, you have to look at the long end of the curve. You got to look at the 20 and the 30-year yields. If 20 and 30-year yields are going up, TLT is going down. If these are going down, TLT is going up. That's it. This is where you're looking. So the question is not why did TLT move, it's why did the 20 or 30-year yields move the way they did? And they move the way they do because of expectations of inflation and expectations of real GDP growth. GDP growth, real GDP. So if we think rates higher for longer, then you're probably going to have some pricing in of higher rates in the longer end of the curve at some point, right? So asking why TLT move is sort of a useless exercise. It's why did yields on the long end of the curve move? Economic data releases have revisions because most of them are survey based, or some of them are made up of components of other surveys. And as you get, as time goes on, you get better information so that you can update previous estimates. Revisions also seem to affect a lot of the values in the report. PCE savings rate for March was shown as 3.2 compared to the most recent report released on Friday having 3.6. Video inferred that the decrease in savings rate and increase in consumption most probably means increased use of credit. And we're looking at the most recent report. Savings rate has been relatively flat due to the revision. Well, that's a problem with data. You get data, and then you get revisions. I mean, that's just the way it works. There's data, and then there's revisions. So one of the big problems with trying to do correlation analysis of saying, okay, well, market prices are a function of, let's say, jobs report, whatever the jobs report is, plus PCE, right? Well, the market will react to the initial report, the first report. And then you'll get revisions later on. But the price responded to what it first saw. However, when you look up a time series of jobs, you'll get the revised. You'll have a revised series. So you're using the revised series against the price when it was initially the first read that we have against the price. That is the nature of economic data. That if you have a time series, you have to say, well, hang on a second, is this all the revisions, or is this time series all the numbers as they initially came out? But yeah, there'll be revisions, and when the numbers come out, all you can do is interpret the numbers that you have. You can't say, well, I think the revision will be this and the revision will be that, so it means this. You can only talk about what you currently have in front of you. Need to choose a topic for my bachelor's thesis, and one teacher only can offer me a topic connected to discounted cash flow, corporate valuation, estimate of company value. The main method is discounted cash flow. What do you personally think about discounted cash flow? What I said about economic models earlier is the same thing for discounted cash flow. It's based on, you have a bunch of assumptions, right? You're going to make some assumptions on revenue growth, on the relationship of certain income statement accounts to certain balance sheet accounts to certain cash flow statement accounts. You have just a whole bunch of assumptions. Cost of capital, you're going to make some assumptions in there on cost of capital. Sorry, CapEx. All of these things are assumptions. A lot of this is just a bunch of guesses. And all of your numbers, as precise as your numbers are going to be, and you come up with a target price and you say, wow, I did really great, they're all based on this. This is uninteresting. This is where everything is in the assumptions. Because it forces you to think carefully about your company. So as time goes on, you can say, well, this assumption was not met, this assumption was met, this assumption was wrong, this assumption, the cost of capital is actually lower, so that would raise my target price. Revenue growth is actually lower, that would lower my target price. So as we get more information between corporate reporting dates, you can then adjust to say, I was a little light, I was a little heavy. So the target price isn't as interesting as the assumptions are. So you can write a paper about about discounted cash flow, and you can sort of say, listen, everything, all the numbers flow from the assumptions. It's the assumptions that are the most critical thing. So how do we come to the assumptions? And you could focus more on methodologies of developing the assumptions, because everything after that is pretty boring. I don't know. That's sort of my opinion. Applied level. Overview video and structure roadmap of how to think about analyzing companies. Sector studies are great, but to get all the structure and tips you give when you go through a company's 10K, I would need to go through all the videos. I don't think so. Excuse me. I don't think so. If you go through the video for the sub-industry, and then you read the 10K, I'm highlighting the very things that we read about so that we should understand what we're reading in the 10K. I don't know that I could do it any differently if I just took a 10K at random and went through it. But there is a structure to the 10K. Maybe I could put a video out talking about the structure of 10Ks. Excited about industry peer group module. Love to suggest adding home builders as a potential group to examine. I did do that with consumer discretionary, D.R. Horton. Heavily influenced by interest rates and other cyclical variables. Significant differentiation in strategies. True. How will utilities be able to invest for growth considering how indebted they are? I understand they earn a regulated return, but don't the investments need to occur before the earnings really take off from this new demand? Well, they earn a return based on the level of their assets. The assets are called the rate base. That is the base upon which they can determine how much their revenue needs to be, such that they can get whatever earnings they get is the return on that rate base. So they have to deal with the regulator and say, here's the assets we're going to be adding over the next how long, and the regulator says, okay, we agree with that, and that's it. So they will then charge that, and then there's some estimate of how many customers they have. So it starts at net income and slowly works up until you get to the revenue requirement. And the revenue requirement will be some number, and then that is divided by the number of customers you have, and that allows you to come up with the cost per customer to deliver the electricity. I would encourage you to go through the Understanding Electric Utilities video, and you'll see that your question is perfectly answered there. As far as the debt goes, who cares? They get a regulated return based on their cost of capital. Okay, not sure if you heard it. BYD released a new hybrid car, 2.9 liters. Yeah, I did read that. Yeah, that is it is rather impressive. I believe their battery supplier is CATL for that one. I thought your sector analyst designation would be a designation for specific sectors, but it sounds like it would cover all sectors. Yeah, so usually you start at the level of the whole and then you slowly add specialties. So I seem to think that the first one, or the first, the more generalist one would be for the all the sectors as a whole. To do each specific one requires a lot more work in each sector, but it will happen over time. When you started, did you have strong emotions with your performance or losing money? If so, how long did it take for you to remove emotions in your trading? For example, making a mistake or closing a position for loss and all of a sudden it recovers. Yeah, that does happen. How did you remove the emotional efforts to continue and move on? Good question. In the beginning, yeah, you're emotional because money is emotional. You worked hard for it. It's your money. You could have done a whole bunch of other things. To simply lose it sometimes is hard to handle. I don't know what transition it was. I think it comes down to don't have any position that can cause you that much grief. And understand, get comfortable with this right away. You're going to lose. Nobody in the history of this game has a 100% track record. You have to become unemotional about it. And if we have $10 in our pocket, we can be unemotional about nickels and dimes, but not $5 bills, right? So if you have a certain amount of money, you have to be diversified. And if you say, well, I only have $5,000, I can't be diversified, an ETF is a diversification. a broad market ETF is diversification. And what you should have is a contribution plan over time. You're not going to become financially independent on a $5,000 account. It's not going to. It's just not going to happen. You're not going to double it to 10,000 this month, then to 20, then to 40, and in 2 years have 18 Lamborghinis outside in your driveway. That's not going to happen. Get that out of your head. That's only in the movies. Not gonna happen. Period. Not gonna happen. What's more likely gonna happen, based on statistics, based on the numbers, is that you'll lose almost all of it within 90 days. That's the reality of it. If you attempt to try to make 18 Lamborghinis in 2 years, you will in 90 days be broke. So you're going to build your wealth with your career, with something else. And you're going to have a contribution plan. And you're going to invest in diversified portfolios until you can create your own diversified portfolio outside of ETFs. That will minimize your emotion. Nvidia has previously established as a volatile stock, considerable price springs. I share the point that we don't short stocks like Nvidia. I did, however, bought November 1060 put after earnings call. Narrative on Nvidia after earnings seems to have solidified with more new chip, additional business growth. Yeah, I understand their new chip, was it Blackwell? The orders are just rolling in. Prospects of price downturn in the next month or so seem low. I agree. A couple of words of critique on the put purchase and possible position management strategies. You can attempt to sell a higher price put that will offset the price of the lower price put that you sold, or that you bought. That would be a bull put spread. Still a defined loss. All you can lose is the amount of the spread itself. Or you could just take your loss and walk away. You don't have to make money the same way you lose money, right? Roaring Kitty's actions is considered market manipulation. Do you think his brokerage or regulator should do anything about it? Well, apparently E-Trade says they want to do something about it, which makes it's kind of curious as to why they would want to do something. What has he done that Warren Buffett doesn't do? Warren Buffett takes big positions in companies and then puts out a form saying, I own ABC. Tells the market after he bought it what he owns. Then he doesn't offer any commentary. He doesn't start saying, oh, you got to buy this, it's going to the moon, it's taking off. He doesn't do anything like that. So what did Warren Kitty do? Posted his trades in a public forum that he had a position in a particular company. He didn't start saying, oh, you got to buy it. He didn't say anything. Just told you, hey, I got this position. That's all he did. Same thing Warren Buffett does. If there's any cause for concern, it's one of two things. Number one, motivation. Warren Buffett posts it, but his motivation is to be a long-term holder. He's not looking to sell it on the fact that people say, oh, you own ABC, and it pops up the next morning. He's not selling into that strength. His intention is to own it. If Keith Gill, when GameStop jumped the next morning, was selling into that, well, was the post the motivation, or was the post designed to increase the price so that he could sell into it? Well, then that's sort of a pump and dump. And even though he hasn't been pumping it in today's world of social media, maybe the word pump needs a new definition. Maybe in today's world of influencers and social media, the very act of appearing to do something causes your followers to come along, that if you don't have a true belief in something and you're doing it just for the pop in the price, the SEC could come along and say your motivation was to pump the stock to sell into it. So there's number one, which kind of hard to prove that as motivation, because you could say when I took the trade, I was serious. But when I saw the jump the next day, I didn't expect that. I thought that over the next couple of years it would double in price, but it did it in one day. And I've always said, when the market gives you a gift, take it. Take it. Even if you have a long-term strategy of holding, just take it. So it's hard to prove. Number two, what he posted was not true. It was a lie. That maybe he did not have a position worth $181 million, because where'd he get it? I mean, the last time that GameStop had a big run, and he sort of gave a little farewell saying, listen, we've had a life-changing sum of money, we're gonna take time and digest it. It wasn't 181 million, it was less than that. So where'd he get the 181? And even if he took that money and he built it up to a big number, why one concentrated bet on a poker game strategy, right? So it could be that E-Trade looked at it and looked at his account and said, whoa, you don't have that. Because it seems to me, with today's technology, you could screenshot something, import it into Adobe, I don't know, or Photoshop, use AI and change it. I'm sure it can be done. I mean, I wouldn't know how to do it because I don't know how to use Adobe or any of that kind of stuff, but I'm sure it can be done. Is E-Trade looking at this because this was a lie? And this wasn't true? And if this was not true, he's in a bit of trouble, because then the motivation is going to be easy to prove. If he did not sell into this and he still owns his position, and it is actually 181 million, that was not market manipulation at all. It was market stupidity, but that's the market being stupid. That's not him doing anything. He can't be held accountable for the stupidity of everyone else. So if he does own that position and he didn't sell that position, I don't know that there's an issue with this guy. I will say he's been very careful not to say anything, almost as if he had some legal advice on this one, that if he was going to do any manipulation, he's doing it in such a gray zone that it's hard to pin it down. That's hard to do without legal advice, right? And if he did have some legal advice on this, then intention was built into the very beginning. Either way, I don't think he's going to avoid an investigation from the SEC. Either way, I don't think he's going to avoid that. So hopefully his ducks are in a row. Hopefully he hasn't done anything silly. because I just can't see how the SEC is going to turn over rocks in different places and just ignore this one. There's a phone call happening soon. There's a letter being drafted. There's an investigation going on. There's a request for information heading over to E-Trade right now. I can't see how it's not going to happen. So I don't think we've heard the end of this one. Signed up for MM level 3. The price for the applied series is still US 440. Well, the three, all you have to do is just add the level 3 plus, and you'll only pay the incremental amount of 320. I did answer you. I answered this one as well, so I won't repeat, because you can always just click on my reply. Same here. I replied for this one, so I won't repeat that one here. I replied on this one, so I won't repeat that one here either. Forecast for 0.3 core PCE was different from Bloomberg forecast to 0.2. Okay, so the Bloomberg forecast might have been different. Sure, I'll accept that. Thoughts on Mexico selling off? Talked about that. What do you dislike about Boardwalk REIT versus the other? I lived in a Boardwalk building once, and I did not like the way they did things. I just thought it was just a greasy way to do business. I didn't like them. The management of the building just seemed slimy. Just didn't like them. Oxy and their potential as an attractive takeout target. I know they've acquired Crown Rock just a few months ago, and they're not particularly. What would you consider a small player? Under what circumstances would an even larger producer be interested in acquiring the company, or would Berkshire look to increase its stake? I don't know. Big deals do happen, so it's not as if big deals can't happen. They do happen. Berkshire, I think, owns pushing up to 30% of this company right now, and they're sitting on $190 billion worth of cash. This would be a blip on their radar, I think, and maybe he wants one nice, really big deal before it's done, and before he's done, I should say. So I don't know. I'm comfortable with this, but I don't know that size is going to be a problem. Big takeover deals happen. I already answered this one, so we'll let this one go. The flaw in this statement is the margin. The margin is a lot more than $600. Thinking the consumer's 100% GDP would have been correct if the government is not running deficit spending. Okay. Why not sell the news on rate cuts? We should not be at 530. It was only anticipation of cuts that led us there. Yeah, you price in the news, and or you price in the expectation, and you sell on the news. The market always does that. The market is forward-looking, so if there's expectations, it gets priced in. Once the news hits, it's like, well, okay, here we are. Now it's time to take profit and correct, because when we're pricing things in, the market tends to price it in 15 times. A headline could come out today and the market prices it in. And then the very next day people say, did you hear about that headline? And it prices it in again. And then if the story appears in another area, same story 3 days later, the market will price it in again. The market tends to price things in more than once. The move to end the session was window dressing. It appears that it could be window dressing, or just a commitment at the end of the month, a commitment of money into the market. Might not have been window dressing. It just might have been done in a way such that there was no price difference between the portfolio and the end of month reporting. Mexico and India, already talked about that. So there we go. That's this week.